folks, I honestly didn't think I'd be making this video quite this soon, but here we are. Silver has officially crossed the $100 per ounce threshold, and I've got to tell you, the implications of what we're seeing right now are absolutely staggering. As I'm recording this, spot silver is trading at $103.47 per ounce. Let me say that again, because I want it to sink in. $103.47. We've not seen anything remotely close to this in the entire modern history of silver trading, and what's happening behind the scenes in the derivatives market may well be one of the most significant financial events of our generation. Now, before I dive into the absolute chaos that is unfolding in the banking sector and these margin calls that I believe are about to cascade through the system, I want to remind everyone that if you're looking to actually acquire physical silver during this historic moment, my friends over at Summit Metals are standing by to help you. I've been working with them for years now, and especially in volatile markets like what we're experiencing right now, having a trusted dealer who can execute on physical delivery is absolutely critical. You can find their link in the description below, and as always, they're offering competitive premiums, even in this wild environment we're in. So let's talk about how we got here, because the move from $90 just 3 days ago to where we are now at over $103 represents a 14% increase in 72 hours. I mean, think about that for a second. A precious metal that a lot of mainstream analysts were calling dead money just 18 months ago when it was languishing at around $23 has now quadrupled, and then some. The velocity of this move is what's really catching people off guard. I've been watching silver for over 15 years, and I've never seen momentum quite like this. What's driving this? Well, it's a perfect storm, really. You've got several major factors converging all at once. First, the industrial demand situation has become absolutely critical. A viewer of mine sent me a report yesterday from a major electronics manufacturer in Taiwan. They're apparently paying premiums of $7 to $8 over spot just to secure physical delivery within a reasonable time frame. That's crazy. The solar panel industry alone is consuming silver at a rate that would have been unimaginable 5 years ago, and there's simply no viable substitute for silver in many of these high-efficiency applications. Then you've got the investment demand side, which has gone parabolic. The U.S. Mint suspended Silver Eagle production 3 days ago due to blank shortages. Let me tell you, when I called my contacts in the industry yesterday, they told me the premiums on whatever physical inventory remains are in some cases $15 to $20 over spot. You're looking at paying potentially $120 for a Silver Eagle right now if you can even find one. The Perth Mint in Australia has reported a similar situation. But here's where it gets really interesting, and this is what I want to focus on today, because I think this is where we're going to see some fireworks in the coming days and weeks. The commercial banking short position in silver has reached what I can only describe as a catastrophic level. Now, we've talked about this on the channel before. For years, a handful of major banks have maintained massive short positions in the silver futures market. The latest CUTS report, which admittedly is already a week old at this point, and therefore potentially outdated given how fast things are moving, showed commercial traders short to the tune of approximately 600 million ounces of paper silver. Think about that for a moment. 600 million ounces. Total global annual silver production is somewhere around 850 million ounces. So these banks are short an amount equivalent to about 70% of total annual production. And here's the kicker. I believe a significant portion of these shorts were established when silver was trading between $70 and $85. So we're talking about paper losses that could be in the tens of billions of dollars right now. Now, how does this actually work? When you're short a futures contract, you're essentially borrowing metal you don't have and promising to deliver it at a future date at an agreed upon price. This works fine when markets are stable or declining, but when you get a vertical move like what we're seeing now, the exchange requires you to post additional margin. It's basically collateral to ensure you can make good on your obligations. So if you shorted silver at $75 and it's now trading at $103, you're sitting on a $28 per ounce loss, and the exchange is going to come knocking, asking for more cash to cover that potential liability. Here's what I'm hearing from my sources in the trading community, and I want to be clear, this is not confirmed. This is what I'm picking up from people who are watching order flow and market dynamics. There are rumors, and I stress these are rumors at this point, that at least 2 major banks received margin calls yesterday that were in the billions of dollars. Billions with a B. One analyst I follow suggested that a European bank may have had to post an emergency $3 billion margin call to meet its obligations on silver futures. If that's accurate, and again, I'm not saying it definitely is, but if it's accurate, that's the kind of thing that can create serious stress on a financial institution's balance sheet. What happens in a margin call scenario? Well, you've got a few options. Option 1, you post the cash. You come up with the money and meet the margin requirement. Option 2, you close out your position by buying back the contracts you're short. But here's the problem with option 2 in this environment. If everyone who's short is trying to buy at the same time to close their positions, that creates even more buying pressure, which pushes the price higher, which triggers more margin calls. It's a feedback loop. This is what's known as a short squeeze, and in my view, we may be in the early innings of one of the most epic short squeezes in commodity market history. Now, there's a third option. This is where things could get really messy. A bank could potentially default on its obligations. They could essentially say, we can't meet this margin call, we can't deliver the physical metal. What happens then? Well, that's when you get into force majeure declarations, cash settlements instead of physical delivery, and potentially exchange interventions. The COMEX, which is where most of the silver futures trading occurs, has provisions that allow for cash settlement in extreme circumstances. But let me tell you, if we start seeing major banks unable to deliver on contracts and forcing cash settlements, the trust in the paper silver market would be severely damaged. And I think you'd see an even more dramatic flight to physical metal. Let me pull up some specific numbers here because I think this really illustrates what's happening. As of this morning, the bid-ask spread on silver futures has widened considerably. Normally you might see a spread of 3 to 5 cents. Right now we're seeing spreads of 20 to 30 cents, which indicates serious stress and illiquidity in the market. Market makers are basically saying, the volatility is so high right now that we need a much wider spread to manage our risk. Also, take a look at the lease rates for silver. For those who aren't familiar, the lease rate is essentially what it costs to borrow physical silver. When lease rates spike, it indicates physical tightness, people scrambling to get their hands on actual metal. The 1-month silver lease rate, which typically hovers around 0.5% or less, hit 7% yesterday. 7%. That's an annualized cost of 7% just to borrow silver for a month. That tells you there's a scramble for physical happening behind the scenes. I also want to talk about what's happening in the Shanghai market because the divergence we're seeing is pretty wild. Silver on the Shanghai Futures Exchange was trading at a premium of about $6 to the COMEX price earlier today. Now, normally you see Shanghai trading at a slight discount or very close to parity with Western markets. When you see a substantial premium develop, it indicates strong demand in Asia and potential delivery issues with getting metal from west to east. I think what we're seeing is Asian buyers recognizing that physical silver is becoming genuinely scarce and they are willing to pay up to secure it. So what about the industrial users in all of this? This is something that doesn't get talked about enough. Companies that actually use silver in manufacturing are in a really tough spot right now. If you're making solar panels or medical devices or electronics, you need silver. It's not optional. But your procurement budget was probably based on silver at maybe $30 to $40 an ounce. Now you're looking at paying $100 plus. That's a massive input cost increase that is going to flow through to either reduced profit margins or higher prices for consumers. Some manufacturers may have hedged their silver exposure, meaning they locked in prices through futures contracts. But many smaller companies don't have sophisticated hedging programs. They're getting absolutely hammered right now. I've also been watching the gold-silver ratio pretty closely through all this. For those who don't follow this metric, it's simply the price of gold divided by the price of silver. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere in the 50s to 60s range over the long term, though it's fluctuated wildly. During the peak of COVID uncertainty in 2020, it hit 125, meaning it took 125 ounces of silver to buy 1 ounce of gold. Then we saw it compress as silver rallied. Right now, with gold trading at around $3,300 and silver at $103, we're looking at a ratio of about 32 to 1. That's the lowest it's been in decades. Some analysts I follow believe this ratio could compress even further, potentially down to 20 to 1 or even 15 to 1 if silver continues to outperform. The argument goes that silver has been historically undervalued relative to gold, especially given its industrial applications, and we're seeing a reversion to the mean or even an overshoot in the other direction. Let me share my personal philosophy here because I get asked about this all the time. Should you be buying silver at $100? Should you wait for a pullback? Look, I'm not a financial advisor. You've got to make your own decisions based on your own circumstances, but I'll tell you what I'm doing. I'm continuing to dollar cost average. I've been buying physical silver consistently for years, regardless of price, because I view it as savings, as wealth preservation. Do I wish I'd bought more when it was $23? Of course, but I didn't know then what I know now, and neither did anyone else. What I will say is this. If you don't already have a physical silver position and you're thinking about starting one, I would not go all in at $103. The volatility we're seeing right now cuts both ways. Could silver go to 150 in the next month? Possibly. Could we see a sharp correction back to 80? Also possible. Markets that go vertical tend to have violent shakeouts. So my approach would be to start building a position gradually, understanding that you're going to see some wild price swings along the way. I also want to address something I've been seeing in the comments and on social media. There's a lot of talk about this being the moment when silver goes to the moon, when we see $1,000 silver, when the whole financial system collapses. Look, I understand the enthusiasm, and I'm excited about what's happening too, but we need to stay grounded in reality. Are there serious stresses in the banking system related to these short positions? Yes, I believe there are. Could this lead to some significant financial disruptions? It's certainly possible. But let's not get ahead of ourselves with predictions of imminent financial apocalypse. What I do think is likely is that we're going to see increased regulatory scrutiny of the silver market, potential interventions by exchanges or regulators to maintain orderly markets, and quite possibly some bailouts or backstops for banks that find themselves in trouble due to their derivative positions. We've seen this playbook before in other markets. When things get too chaotic, when systemically important institutions are at risk, governments and central banks step in. Whether that's right or wrong is a different conversation, but it's the reality of how the system operates. Now, let's talk about where silver might go from here, because that's what everyone wants to know. I've been looking at technical analysis, though I'll be honest with you, in a market moving this fast, a lot of traditional technical analysis goes out the window. That said, there are some analysts calling for $125 as the next major resistance level. Others are pointing to $150. The most bullish forecasts I have seen are suggesting we could potentially see $200 if we get a true blow-off top. But here's what I am watching more than specific price targets. I am watching the behavior of the commercial traders, the open interest on the COMEX, the available physical inventory, and the lease rates. Those are the indicators that will tell us whether this is sustainable or whether we're approaching a climax. For example, if we start seeing a significant reduction in the commercial short position, that tells me banks are capitulating and covering, which could fuel even more upside. On the other hand, if we see open interest on COMEX futures start to decline sharply, that could indicate a lot of contracts are being closed out and we might be nearing a top. The registered silver inventory on that COMEX is another key metric. Last I checked, which was about 2 days ago, so this could be outdated, there were approximately 40 million ounces of silver in the registered category, meaning available for delivery against futures contracts. Sounds like a lot, right? 40 million ounces. But when you consider that a single futures contract represents 5,000 ounces, that's only 8,000 contracts worth of physical silver available. The total open interest in silver futures is measured in the hundreds of thousands of contracts. So if even a small percentage of contract holders stand for delivery, demanding physical rather than rolling their contracts or settling for cash, the registered inventory could be depleted very quickly. This is what some people call the Achilles heel of the paper silver market. It's built on the assumption that most people won't actually want physical delivery. They're just trading price movements. But in an environment like this, where trust in the paper market is eroding and physical premiums are going crazy, you might see a lot more delivery demands. And that's when things could really get interesting. I want to circle back to those margin calls I mentioned earlier because I think this is going to be the story over the next several days. If these rumors about multi-billion-dollar margin calls are accurate, we need to understand what that means for market stability. Banks don't keep billions in cash sitting around doing nothing. That money is deployed in various investments and loans. So when they suddenly need to come up with billions for a margin call, they have to sell other assets or borrow money. That can create stress in other markets. We might see pressure on stocks, bonds, or other commodities as banks liquidate positions to raise cash. Furthermore, if a bank is in serious trouble due to silver derivative losses, you could see a broader crisis of confidence. We saw how quickly things can spiral during the Silicon Valley Bank situation a few years back. One bank's problem became everyone's problem, as depositors at other regional banks got nervous and started withdrawing funds. Now, I'm not predicting that scenario, but I'm saying it's something to be aware of as a possibility if this situation deteriorates. There's also a geopolitical dimension to all this that I think is worth considering. Silver is denominated in dollars on global markets, and what we're seeing is essentially a massive repricing of silver in dollar terms. But from the perspective of other currencies, the move might be even more dramatic depending on what's happening with exchange rates. Countries that are major silver producers, like Mexico and Peru, are seeing enormous windfalls. Countries that are major consumers but don't produce much domestically are facing a serious cost shock. I've also been thinking about the strategic implications of silver scarcity. If industrial users genuinely can't secure enough silver for critical applications, you might see governments getting involved, potentially releasing strategic stockpiles or implementing export restrictions. We've already seen this kind of thing with other critical materials like rare earth elements. Silver's role in defense applications, in solar energy, which many governments view as strategically important for energy independence, and in medical applications could prompt government intervention if markets get too tight. You know what's fascinating to me? The mainstream financial media has been relatively quiet about this silver surge compared to when we saw the GameStop situation or even previous precious metals rallies. I think a lot of traditional analysts don't quite know what to make of it. They're used to covering equity markets, bond markets, maybe even Bitcoin. But commodities, and particularly silver with its dual nature as both industrial metal and monetary metal, doesn't fit neatly into their frameworks. I expect we'll see a lot more coverage in the coming days as this story becomes too big to ignore, but right now it feels like a lot of people are just waking up to what's happening. So what should you be doing right now? Again, not financial advice, just my thoughts. First, if you have physical silver, I'd be making sure it's stored securely. With prices this high, the unfortunate reality is that theft becomes more of a concern. Second, if you're thinking about selling some of your position to lock in profits, that's a legitimate strategy. There's nothing wrong with taking some chips off the table after a massive run-up. Personally, I'm holding my physical because I view it as long-term wealth preservation, but everyone's situation is different. Third, be very cautious about chasing this move with leveraged products or futures contracts unless you really know what you're doing. The volatility we're seeing can wipe out accounts very quickly if you're on the wrong side of a move. I've seen people get crushed in volatile markets because they over-leveraged at exactly the wrong time. And fourth, stay informed but don't obsess. I know it's tempting to check prices every 5 minutes when things are moving like this, but that's a recipe for stress and poor decision-making. Have a plan, stick to it, and don't let short-term noise distract you from your long-term objectives. Looking ahead to next week, there are a few things on the calendar that could impact silver prices. We've got economic data releases, including inflation numbers. We've got Federal Reserve speakers scheduled, and of course, we'll get the next COTS report, which will give us updated information on commercial positioning, though by the time it's released, it'll already be several days old. I'll be doing my usual Sunday night market watch, where we can look at how Asian markets are opening and what that might signal for the week ahead. I'm also going to be watching very carefully for any announcements from the COMEX or other exchanges about potential rule changes, position limit adjustments, or other interventions. In past situations where commodities have made extreme moves, exchanges have sometimes stepped in with circuit breakers, increased margin requirements, or other measures designed to cool things down. Whether that happens here remains to be seen, but it's something to keep on your radar. In terms of where I think this ultimately goes, my base case scenario is that we're in the middle of a genuine paradigm shift in how silver is valued. I think the days of $20 to $30 silver are probably behind us for the foreseeable future. Even if we get a significant correction from current levels, I believe we've established a new, much higher baseline. Whether that baseline is $60, $70, or $80, I'm not sure, but I don't see us going back to the price levels we saw just a couple years ago. The fundamental story for silver remains incredibly strong. Industrial demand is growing, mining supply is relatively inelastic, meaning it can increase quickly even with higher prices. And investment demand is surging as people look for alternatives to traditional financial assets. Layer on top of that the short squeeze dynamics we're seeing in the paper market, and you've got a recipe for continued upward pressure on prices. That said, and I really want to emphasize this, markets never go straight up forever. We will see corrections. We will see pullbacks that feel scary. There will be days where silver drops $10 or $15 and everyone panics thinking it's over. That's just how markets work, especially volatile ones. The key is to have the conviction in your thesis and the patience to weather those storms if you believe in the long-term story. All right, folks, I think I've covered the main points I wanted to hit today. We are witnessing history in the making with silver crossing $100 and the chaos that appears to be unfolding in the derivatives market. Those margin calls, if they continue and escalate, could be the catalyst for an even bigger move higher. We'll be watching closely, and I'll keep you updated as this situation develops. I want to hear from you in the comments. What do you think happens next? Do you think we've seen the top for this move, or are we heading higher? Are you buying, selling, or holding at these levels? And for those of you who've been stacking for years, congratulations. You've been patient, and you're seeing the fruits of that discipline. As always, please do your own research. Don't invest money you can't afford to lose. And remember that I'm just sharing my analysis and opinions here, not giving financial advice. If you found this video helpful, I'd really appreciate it if you'd give it a thumbs up. Share it with anyone you think might benefit from this information. And if you haven't already, subscribe to the channel and hit that notification bell so you don't miss future updates as this story unfolds. Thanks so much for watching, and I'll see you in the next one. Stay safe out there, and happy stacking.